So for you guys that are watching YouTube, yeah, Cav, it's my, I'm sorry guys, it's the YouTube audio that wasn't on. So if you click on YouTube, you're gonna miss my little bit in the beginning, but the microphone's on now, which is perfect because now we're gonna get into the meat and potatoes of it. We're gonna learn the trigger line and the Fibonacci rules for when it's okay to trade, which means when the rules are met, it's okay to trade. When the rules aren't met, maybe sit on your hands, embrace that 90%. You guys have the ability to simulate, to practice, to get in there and really, mess some stuff up, new users. Don't be afraid to make mistakes. But the first step in becoming a confident trader ASAP in this room is posting your trades in the room, posting your trades in the class. Show me what you see. Show me your chart reads. And Jerry did a great job of that. Jerry dropped this in the room and he goes, check it out, Mark. There's one of those strong tops. There's the triggers rolling. There's potential entries. Look at the termination condition. And then Jerry put, that's a weak bottom. Triggers go below the blue fibs and triggers. And then Jerry, do you see how none of the trigger lines broke through that big fat fib? So that's a strong bottom, my friend. So when you post in my room, we may find where there's a challenge with your read, and then we'll go back and revisit the rules. Price reached this fib and the triggers got through, but on the second fib, Jerry, none of the triggers break and it reverses. That is a very strong bottom, which is why this was such a great looking potential entry. Does that make sense? And guys, that's what we do. Every time you post in the room, the cool thing is you're getting a private session with me. So it's important that you do what Jerry did. It's important that you take the time to write on your chart. Whoops, that's the wrong one. It's important that you write on your chart and you tell me, this is what I saw. And this is where I saw it. And this is why I did what I did. And guys, we'll go through every picture presented. I'll drop this in here, but you're going to get a copy of this anyway. It's on the spreadsheet that I'm going to give you. We're going to go through every picture. And we're going to talk about all the advantages, and we're going to look at your entries, and we're going to look at your exits. And the whole thing is that I'm going to make sure that your chart read is accurate, that your entries had the least amount of risk, that your exits made sense. So it's a private session. Don't be afraid to post in the room. Don't be afraid to be wrong. Because when I'm wrong, that's when I learn the most. When my brother has to correct me, hey, Mark, this is what I saw. I know this is how you saw it. But here's how you can do it better. You end up a better trader. We will simplify this morning. I'm gonna give you a plan with 2 trades in it. There's going to be a high probability trend trade, what we're discussing for the entire first hour. And there's also going to be what's called a medium probability trade. And a medium probability trade, and that definition is found right here in the frequently asked questions. It's defined as when most indicators line up for a trade, however a small issue exists. So you're going to identify that issue by learning how to talk to yourself in terms of advantages. When it's a high probability trend trade, you'll be able to say out loud, I have momentum, I have a clear path, there's my defined entry. When it's a medium probability trade, you might say, I have momentum, but my path isn't quite clear. I need to make sure I have the perfect entry. And because one of my advantages is gone, I'm going to manage it more assertively. And your ability to recognize advantages is going to let you know when it's time to put on that management hat. So I'm going to give you a plan with 2 trades in it. You're going to learn the looks that you'll commit to. You're going to learn what it looks like to take that trade. You're going to commit that pattern to memory until it becomes easy. And that's where the second step in becoming a confident trader ASAP is. It tells you to use the spreadsheet that Nexgen provides you. I drop mine in the room every morning. I'm doing it right now. And this spreadsheet is really a tool that embraces the idea that repetition creates recognition. That if you do the same thing over and over, if you see the same thing over and over, if you type the same thing over and over, what happens is it sticks and it becomes easy over time. So your first tab is the basic rules. The first advantage is strong triggers in green. There's over 50 pictures that I've put in there for you. And then the opposite, when you have to embrace that 90%. The same thing with the clear path, rule number 2 being met. And then the opposite, those termination conditions that could stop the market. Know the difference between the two so you know what looks you're committing to. I'm going to give you a sheet of paper with a little drill on it that's going to help you use this tab to get to where you want to be faster. There is the client trades tab, and this is where I love it. I steal pictures from you guys all day long. When you post in my room and it's a high probability trend trade or it's perfect execution on a medium probability trade, I throw it in this green section. And guys, this is a great study guide for you to come back to, for you to look at these pictures and start putting those patterns in your brain. There is some stuff on the NASDAQ for you adrenaline junkies. There is the most basic management plan I could ever come up with. This will be in the plan that I hand you. This is just the picture story to go with it. Ideas when you can manage differently, maybe hold for bigger moves. And then the cool thing, I think it's cool, is you're going to begin to recognize patterns. So I've spent 30 days focused on a high probability trend trade. I've learned how to take that medium probability trade, but I keep noticing. Maybe you keep noticing that when price accelerates from the large triggers, it almost always pulls back to the large triggers, and that's the gap theory. Or you might notice that when strong triggers go into an area, maybe it retests the area once or twice, and you'll start to recognize patterns. And from those patterns, you might modify your plan. You might find another entry. You may create a whole new trade like some of you have. So under the Build Your Plan tab, initially you're going to fill this green section with high probability trend trades. As you grow with the software and find more opportunities, you may put 50 pictures of your next trade in there. You're going to talk about management. I'm going to talk about management. You'll be able to fill this with management opportunities. And then the patterns that you see. Yeah, Better Dad's one of us. He drank the Kool-Aid. I love it. And then finally, this is your trade journal. The final tab, the trade tracking, is your trade journal. And the trade journal is where you're going to post your pictures. So I took a trend trade short. Did I have momentum and a clear path? I sure did. What did Mark say? This is the perfect entry. Hey, what's up, Wayne? And what happens is when you come in and you post in my room, we're going to talk about everything. We're going to talk about the good and the bad. We're going to talk about the fixes that need to happen. We're going to talk about the stuff that needs to be repeated. So in just 4 or 5 pictures from you, I'm going to start to recognize your patterns, the things that you like to do. And if you come back and you're posting in this sheet and you're using the feedback, you're going to begin to see the patterns maybe that aren't beneficial. I keep trading into termination conditions and I keep losing, and dag nabbit, Mark's going to help me develop a plan to start avoiding that. And you're going to use this spreadsheet, and this is the best way, guys. I still do this every day. I look at what I did yesterday, and I ask myself what worked and what didn't work. And the things that worked, I try to repeat. And the things that didn't work, I try to avoid. And it just sets me up for the day, guys. And it accelerates your learning if you take the time to go study what you did, because it's going to help you get to where you're going. So that's what we're going to do. We're going to learn the rules. You guys are going to practice and ask for help. I'm going to hand you a plan, and by the end of this first hour, in the next 60 minutes, I'm going to give you everything that you need to be successful with the software, with the omission of the experience and the repetition to make it seem easy. That's going to be your task, is to get in there, to take these pictures, and to really commit these looks to memory. So, what are we looking at on the charts? Brand new users. Do I have any brand new users with me today? Any demos in here? I'm going to remind you guys, this is what it feels like in the first 3 or 4 days, I would say. You were drinking from a fire hose. Hey, great to have you, Lonnie. So, Lonnie, if you feel like this, it's okay. I want you to know that that's pretty normal for the brand new user. because right now we're just learning terminology, and you're learning to kind of hear what I'm saying, and you may not know exactly what it means. Lonnie, I want you to be real vocal in my room. If you have any questions, if you need any clarity, just say, hey, Mark, what do you mean? What is that? Talk about that. And I always will. And that's why I start my first hour getting into this intro. We're just going to identify the pieces that you're going to see on the chart. So guys, every chart, the large chart and the small chart will have trigger lines. There are small triggers. It's two solid lines that create the small triggers. They're a fast moving average. And that is twice as much information as you need with these trigger lines. There are large trigger lines. They're the dashed lines. They're a slow moving average. And guys, triggers are the same no matter what chart you're looking at. The only thing that you need to know is that these are small, two solid lines, and these are large, two dashed lines. We're going to use triggers to make sure rule number 1 is met and identify momentum. We're going to use triggers to make sure rule number 2 is met and identify termination conditions. And we're going to use triggers to pinpoint our entries on that smaller, faster chart. And again, for you guys that are new, you see a lot of people posting in the room, dropping in those screencast links to pictures of trades they took. The second half of class, I go back to all those pictures. But if you ever need instant feedback on it, all you have to do is let me know. But we go through the rules and the identification first, and then we come back and we see how everybody did with the rules. So I'm not ignoring anybody. Just want to let you know that. I had someone get mad at me once because I didn't stop class to look at his picture. So I like to make that clear. Each chart has areas. Areas have a different role depending on whether it's the large chart or the small chart. But let's just name them. So we have a divergence high. Divergence just means loss of momentum, guys. And it will print a magenta line if there's a loss of momentum at a high pivot. There's Fibonacci resistance, which is the red line that runs horizontal. There's Fibonacci support. It's the blue line that runs horizontal. There is a divergence low, which means that there was a loss of momentum at that pivot. At a low pivot, it's a cyan line. There's yellow one-to-ones. These are like fibs that print in the moment. These will start and stop throughout the day. They can be support or resistance. And then there's a midband. And the midband runs through the middle. And you don't need to know how they came to be. You don't need to know the math that goes into them. You don't need to know the settings for the indicators. All you need to do is be able to recognize them and give them a name. So simplicity really is my focus. And that's why 3 rules tends to work so well. Large chart always leads the way. Large chart always defines the first 2 rules. Large chart, rules should be met before you even think about looking for an entry. So rule number 1 says large chart needs strong trigger lines. Why? Because it gives us the advantage of momentum. So I open up my sleepy eyes, my workspace opens, I look to my large chart, and I notice that the background color tends to change. If the background on my large chart is green, the market's going up, and if it's red, it's going down. Remember, we're talking for the new users. So the easiest thing to do is look for rules to be met to go up with it or to go down with it. And rule number 1 is going to start that off with strong triggers. So strong triggers in an uptrend means that your small triggers are up and above the large triggers. Your large triggers must be wide, angled in the direction of the trend, and it's the space that's created between small and large triggers. I want you to picture it. It looks like scissors that just opened. That space that's created lets me know that the odds are favorable for the market to continue up. So you're going to hear odds favorable momentum in this room a lot. You're going to see OFM tattooed on charts all day long, guys. Strong trigger looks. The only way you can have it in an uptrend is if all your triggers are green. In a downtrend, small triggers are below the large triggers are wide. It's the space between the two that lets me know that the odds are favorable for the market to continue down. Once again, odds favorable momentum, guys, OFM. And when you have odds favorable momentum, the market is likely to push in the direction of the trend. When you have odds favorable momentum, That's what you typically need to break key areas. When you have odds favorable momentum, it will help to cover some of the mistakes that new users tend to make. And guys, these strong triggers in an uptrend are when that one bar typically sprouts a tail or a wick. Anytime you see strong triggers in one of these tails, you can go back and use that to study this pattern. This is a potential entry for a long trade. This is a potential entry for a short trade. So scissors open is strength. Is everybody good with that? And then when your scissors close, when your small triggers work their way inside of the large triggers, guys, this is a weakening of the large triggers. When I have weak triggers, anything can happen. When I have weak triggers, the market may retrace from the middle of nowhere. When I have weak triggers, key Fibonacci areas are more likely to hold. So I'm a big fan of language. For those of you that share my affinity for it, I want you to see the correlation. Strong triggers, odds favorable to continue. Weak triggers, anything can happen. When you're making the decision to take a trade, guys, it should be evident which one is your highest chance of success. So let's take a look. Strong triggers pushes a market right up to weakness at a key Fibonacci area. There's your reversal, creates strong triggers. Guys, there's tails with strong triggers on both sides, both potential entries. You can circle these tails, come back and study them. And then it weakens right at a key Fibonacci area, and that's where the reversal comes in. Pretty cool, right? Strength pushes, breaks areas. Weakness is precisely where the reversals happen. I love that. Everybody's good, right? Yeah, Mark. And remember, I ask if you're good. I ask if it makes sense. I ask if you understand, not for me. Because if something isn't right, if something doesn't click, if something doesn't register, I want you to say, hey, Mark, do me a favor. Go find another example and talk through it. Hey, Mark, show me a different picture. Let me know. Because strong triggers are rule number one for a reason. So this is your trade flow chart, right? If the large chart has strong triggers, then I will make sure that there's no termination conditions. Termination conditions are those likely to stop the market areas. Termination conditions, when there are none, make sure that we have room to our targets. And we're just going to call it a clear path. And you'll see that annotated on charts a lot. CP, clear path. Termination conditions are those Fibonacci areas that could stop the market. And an easier way to say that, termination conditions, whoops, there we go, are those horizontal lines on a large chart. Divergence highs, divergence lows, Fibonacci resistance, Fibonacci support, yellow one-to-ones, all of these have the potential to behave as a termination condition because these are the areas where the large crowd is making decisions. These are the areas where buyers buy, where sellers sell, where fights happen, where reversals tend to come from. So we're going to use those areas in a comparison with the trigger lines to make sure that we're not trading in an area likely to stop the market. And I'm going to back up one step. Your strong triggers, your advantage of momentum is solely trigger lines. It has nothing to do with the bars. It has nothing to do with the areas, guys. It's the separation, simplicity. And then once I have strength, we're going to make sure that we have a clear path. So if these areas are where decisions are being made by the people that control the market, if these areas are where potential reversals can happen, the first step in identifying a termination condition is letting price get to the area. Let price reach resistance because that sets off the decision-making process. That makes the buyers want to exit or the sellers want to enter or the two want to fight one another. So when price reaches the area, we're done with price. That sets it off. The triggers will tell the story. If your triggers, actually let's do the second part, ask yourself out loud, where are my triggers? Price reach resistance, where are my triggers? If the triggers remain below resistance, resistance is a termination condition. Resistance could create an untradeable bounce. Resistance could set off a fight between the buyers and sellers that you don't want to be a part of. Resistance could break Or resistance could reverse the market completely. Those large triggers go from green to red. Guys, if none of the triggers get through and it reverses the market, we're going to call this a strong top. And a strong top is the precursor for the highest probability trend trade you could ever take. A strong top is rule number one for that medium probability trend trade I'm going to give you a plan for. So, price reaches the area, where are my triggers? And as long as they're below that area, rule number two is not met, absolutely no trades into the area. Well, it does reverse, it does become a strong top, odds favorable momentum, and then it reaches Fibonacci support. You may or may not have found an opportunity to trade in there. If you did, support offers a beautiful target. That's where the market's likely to go with this momentum. But when price reaches support, where are my triggers? They remain above support. Support might create an untradeable bounce. It could create a fight between the buyers and sellers. It could break, or it may reverse the market completely. And if it reverses the market completely, guys, this is a strong bottom. And a strong bottom is rule number one for the medium probability trade, and a strong bottom is the precursor to the highest probability trend trade you could ever take. So, when price reaches an area and the triggers remain above, I just want you, or below, I want you to say to yourself, I don't know what's going to happen. There's 4 options and I can never be sure which one it is. So the highest chance of success comes from waiting to see what the reaction is. If the area is going to break, guys, this is what it looks like. Price reaches, no trades because the triggers are below. We're exercising our right to embrace 90% of the day doing nothing. If your small triggers smash through the area, but your small triggers remain, or your large triggers remain below, forgive me, as long as you have momentum, the area has the potential to break. This is your second trade look. It's only potential. The path isn't clear yet, so it needs to be managed assertively. But once the small triggers and the large triggers get north of resistance, resistance behaves as support. The area is broken. Your path is clear and will stay clear until you reach the next line, and then we go back to number one. Same thing in a short. Price reaches support. All the triggers remain above. Let's do nothing. Let's wait for the reaction. The most broken rule among new users and old users is trading directly into termination conditions, hoping they break instead of allowing them to break. From a termination, if it's going to break, it's going to turn into the potential to break. Have to manage these assertively. This is going to be most of your trades, guys. But once small and large get below support, support is broken, the path is clear, and it remains clear right until you hit the next area. And then you have to start the process over. So let's go back to a big chart again. And just putting on a clinic, guys. I want you to see this. And you know what? I made this workspace based on a conversation. Thank you, Better Dad. Guys, this is feeder cattle. Feeder cattle. Who the hell trades feeder cattle? I don't know. But coming from support straight to resistance, resistance holds, reverses the market. Odds favorable momentum breaks areas. It begins to weaken. Look at that. With the weakness, it retraces right to resistance that used to be support. Down it goes, does it again, and then the push-up starts directly from Fibonacci support. Even in feeder cattle, these fibs are powerful. Straight to resistance, back down to support. That's where they launched up, and weakness creates a giant retracement. Pretty awesome, right? Couple entry opportunities in there. Guys, it doesn't matter what market you're trading. It doesn't matter if it's feeder cattle or silver or gold or the ES or crude oil. The cattle know when the cows come home. The rules are the same, guys, and they're consistent. So is everybody okay? Price reaches an area, do nothing if the triggers haven't broken. Smalls break through, large don't, it has potential. And once you have a clear path, we're just looking for entries, guys. We're going to go to that smaller, faster chart. And here's the sad face for most traders. There's going to be times when your path isn't clear, because areas are stacked, because there's multiple fibs or any of those areas that may stop the market. This is 90% of your day. 90% of your day, and it's okay to do nothing. And I love the phrase, and you'll see it in the room, sometimes people typing it on their charts. NMM, price reach Fibonacci support, the triggers are above, any trade, any breakthrough, it's not my money. Because it's not my pattern, because it isn't proven to win more than it loses. And you may get that 3 or 4 times in a row, guys, and it's okay. Because the futures markets exchange billions, trillions daily, billions hourly. You don't have to be in every move. You don't have to be the first one in. You don't have to be the last one out. Your path to success comes from making money with all that momentum and nothing in the way, trading from key Fibonacci areas, trading to key Fibonacci areas, and understand, and this is the best lesson you'll ever get. Guys, trust that the next trade is coming. Trust that the next opportunity is on its way. Trust that the market isn't done because there was one trade at 7 a.m. Patience, patience, patience. So is everybody good? Can you give me a why in the room? Price reaches, do nothing. That's the most important lesson I want new users to take out of this. Here's a little bit of that refinement process. Remember, the large chart is a slow chart. It's a broad stroke of a brush, guys. It's hard to see change on a large chart. Awesome. Lonnie, I'm looking for your whys today for sure. Inside of this one bar on the large chart, there's that refinement process that we talked about. You see all of these bars on a small chart. And guys, you're not going to see change coming on the large chart. It's slow. But the small chart can give you a heads up that change is coming. And this is the only termination condition that I'll accept on a small chart if 3 divergences print on the small chart. So 3 cyan lines coming off of pivots from a low, 3 magenta lines coming off of pivots from a high. Guys, 3 divergences in the same price range can terminate the trend. And this is the small chart telling you that even with all this momentum, times they are a-changing. So 3 divergences from a low or a high is the only reason that I'll not take the entry for a high probability trend trade. So here's where it gets fun. We've looked at the large chart. We have established the trend. We have verified that we have strong triggers giving us the advantage of momentum. We have verified that there's no termination conditions in the way. We have a clear path. Guys, we're going to go to the smaller, faster chart, and we're going to refine that one bar, and we're going to find our entry. We're going to pinpoint where the market is most likely to continue. And we're going to do it with such accuracy that you guys are going to use a limit order to buy or sell a pullback at an area inside of triggers. You're going to wait for the market with an order. You're not going to chase price. You're going to wait and you're going to let the small crowd fight and push back to your limit order. Fight that trend that's going up with a down move, or fight that trend that's going down with an up move. And you're going to be waiting right at an area, at a fib, at a mid-band, at a yellow 1-to-1. So the way areas on the large chart could stop the market and create an untradeable bounce, areas on the small chart, as long as they're inside of triggers, can create a bounce in the direction of the large chart trend. So inside of triggers is a very big part of the entry rules, because triggers are going to define where that retracement, where that fight is most likely to occur. So either the 5-1 large triggers or the 13-2 large triggers. Both of your charts have large triggers, and this is a great example. Price returns to large triggers. Do you guys recognize the gap theory there? Absolutely no short trades because price returns to the large triggers. Well, it happens on a small chart too. Price returns to the large triggers. So we've put the 13-2 large triggers on your small chart. And this just defines where the retracement is most likely to occur. So getting back to the idea of the best, your lowest risk, most accurate entries will come from what we call favorable large triggers. And favorable large triggers mean that the large and the synthetic, the 5-1 and the 13-2, are overlapping, one on top of the other, like 2 snakes riding piggyback. Because when that happens, you have the least amount of space where the retracement is most likely to return. And then when you put fibs, midbands, or yellow 1-to-1s inside of them, you have the smallest little window where the market is most likely to bounce and continue with the trend. So I like using the phrase, I'm going to buy or sell a pullback at an area inside of favorable large triggers for the new user, because that will reduce risk and maximize profit potential. All right, let's get into the good stuff, guys. Let's define our entry. And before we do this, I want to show you this picture. The large chart in this scenario says up. The large chart says odds favorable momentum, and the large chart says absolutely nothing in the way. Our rules are met on the large chart. And guys, you're picking out your entry where this tail is likely to form when the market is way up here at the top of the bar. And it's going to look like this on the small chart. Everything will be screaming north. And your fear of missing out is going to kick in, full tilt boogie. And you're just going to want to jump into that trade as a new user. But when the large chart rules are met, I need a reversal bar on my small chart. I need that small crowd to fight. In your reversal bar on the small chart, it's not the entry. The reversal bar on the small chart is the beginning of the retracement, the beginning of the pullback, the beginning of the fight, however you want to say it. And we know, because Mark tells us every day, that price tends to return to the large triggers. So your small chart, you have large triggers and you have synthetic triggers, those large triggers from the large chart. From the highest line of the triggers to the lowest line of the large triggers, guys, this is where the market may retrace. The tighter they are one on top of the other, the smaller the area becomes, and that helps with accuracy. So first we wait for the reversal bar, and then you're going to identify where the retracement is most likely to occur. We're going to make that box a lot smaller. When you identify the trigger lines, you understand where the market may return. Now you need an area inside of triggers. And guys, that word inside is so important. Areas can be fibs, areas can be a midband, areas can be a yellow 1-to-1. Areas are not divergence highs and lows. Areas are not those pink 1-to-1s that I wish my brother would take off the small charts. So fibs, midbands, or yellow 1-to-1s inside of triggers. All caps, shouting from the bottom of my lungs to anyone that will listen. Inside of triggers, inside of the retracement area. So this box, from the highest area inside of triggers to the lowest area inside of triggers, it shows me where the market is most likely to bounce in the direction of the trend from the large chart. It shows me where the small crowd is most likely to fail in their attempt to fight the large chart. So with a little bit of study, you're going to develop the faith in it to activate a limit order 2 ticks above the highest point of support. This is your entry for the highest probability trend trade. And you have done all you can do. Now it's up to the market to get you in, guys. You're done. You'll never be in control of anything of whether or not you followed your rules. But if price reaches your order, guys, you're in a long position. You're in that trade. And you have the advantage of a market where the odds are favorable for it to continue up, and that feels good. And you have the advantage of a clear path, giving you room to your targets because there were no termination conditions present, and that feels good. And you have the advantage of having entered precisely where the market is most likely to continue with the trend, and that's got to feel good. And guys, that's your entry. That's your high probability trend trade entry, and the recipe is the same whether it's up or down. So when the large chart rules are met, we're waiting for the reversal bar. The reversal bar is not your entry. It signals the beginning of the fight. You can really, with pretty awesome accuracy, know where the retracement is most likely to occur from the high line of the trigger lines to the low line of the trigger lines. You can get even more specific and understand where it's going to bounce from the highest area to the lowest area for a long trade. And guys, that blue shaded area is what we're going to call the window of opportunity. The window where the small crowd is most likely to fail. The window where the trend is most likely to continue. And you're going to activate your limit order 2 ticks above the highest one. And you're going to say to yourself, it might go lower. but I'm not going to miss this trade. It could push lower, but I'm willing to ride that out. I'm not going to miss this trade. And what's cool is when you can identify where the retracement is likely to go, when you can identify where the market is most likely to bounce, you're going to learn to ignore any areas on the wrong side of the triggers, below the triggers for a long trade, because we're going to call this area where the market should not go. The market should not push through the retracement zone. The market should not push through the areas if this is going to be a winner. So any line is outside of the window if it's not inside of triggers. And the same is true for shorts. Reversal bars print, not the entry, signals the beginning of the fight. Retracement can be defined most likely to occur from the lowest line of the triggers to the highest line of the triggers, but the market is most likely to bounce off of the area inside of triggers. You're going to put your limit order 2 ticks below it and say, you know what, I'm cool if it goes up to the top of the retracement zone. I'm all right with it, because this is where my advantage of rule number 3 lies, at the point where the market is most likely to continue. And by defining where the market is most likely to continue, you know that it shouldn't go beyond the triggers, beyond the areas inside of the triggers, and none of these areas are a part of the window of opportunity because they're outside of the trigger lines. And you're going to use that concept of defining where the market is most likely to continue to identify where the market should not go. And guys, generally 4 to 5 ticks above those trigger lines is where your initial stop is going to be. So recognizing great entries gives you the opportunity to understand stop placement right out of the gates. And here's the other thing. I always tell people that you might not be able to take a trade because areas are stacked. And that bums people out because it keeps them sidelined. Here's the other truth about trading. I'm not even going to call it a sad truth. Is that anything that wins 70 to 80% of the time is obligated by math to lose 20 to 30% of the time. You will not win every trade. Your goal should be to take the right trades, to have an edge, to have a statistical advantage, to trade a pattern that has been proven to win more than it loses. And then you know every time you take this trade, it has the potential to push through and take you out, and you become okay with that. That's what we call acceptable losses. If you don't follow the rules, that's what we call avoidable losses. And those are the ones that we want to pull out of the mix. So, large chart says up. Large chart has momentum. Large chart has a clear path. Guys, the market is trading all the way up here, and you've made the decision that it's time to enter. Everything inside of this one bar is the beginning of the pullback, the retracement to areas inside of triggers, and the market continuing in the direction of the trend. This is your refinement process. This is the pattern that you're learning, guys. This is the pattern that you're looking at, that you're committing to memory, and you're reminding yourself that once the large chart says go, I'm done with it. It's just a matter of waiting for the reversal bar, identifying the triggers. Can we do the triggers? There we go. From the top to the bottom of the triggers. And then pinpointing where the market is most likely to continue, knowing exactly where your stop goes. And guys, if this is where the market shouldn't go and you enter on the reversal bar, your risk is huge and your profit potential has been diminished. And if you get head faked and jump in fearful that the market's going without you, your risk is still huge and your profit potential has diminished. But if you wait for the areas inside of triggers, you're typically going to have the least amount of risk. And the other part of it, and the cool part of it, is that you're going to have the furthest room to get to trouble. You're going to increase your profit potential. So you need to learn these patterns, commit them to memory, get to the point to where you trust them so that you can always take that entry. And let's go back to one of those circles. So on the large chart, and guys, this is after the fact, and this is good. Lonnie and Better Dad, and you guys that are really studying and getting into this. Does everybody see that there was odds favorable momentum on the large chart? Watch this. Let's take off the cheater, and we'll go like that. Odds favorable momentum on the most current bar. Does everybody see it? Sure do, Mark. Awesome. Dun, 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 dun. This has the potential to break. The smalls have smashed through that area, and the large haven't quite made it. Guys, this is going to be a medium probability, but the entry rules are the same. The small chart is screaming to the downside, and I am despondent because I wish I was in this move, and I'm not getting paid, and Mark is a snake oil salesman, and this sucks. I hate Nexgen. And then the small chart gives me a reversal bar. And at the time of the reversal bar, I go, whoa, let me go through the process. Let me define where the retracement is most likely to occur, from the bottom of the triggers to the top of the triggers. Let me pinpoint where it's most likely to continue, from the lowest point of resistance to the highest point of resistance. Is everybody with me? We've defined where the market is most likely to continue. Are you going to have the courage? Whoops, it's not going to let me put in a stop. To put in a limit order 2 ticks below it and say, come get me, small crowd. And if they do, whoops. And if they do, you're in a short trade. And you're in a short trade, guys, from the best of the best spot. You're in a short trade where the market is most likely to bounce. But you're saying to yourself, it could go up further. I still have a zone. Let me put my stop where the market shouldn't go. And watch this. Fear. Oh my gosh. Oh no. This stinks. What's going on? Why won't it win? I'm so... And then down it goes. When you trust the pattern, this doesn't faze you because you know you're in the retracement zone, because you know you're still in the window. And you can study this by going back and circling those tails, because look at this. If I put that box on the highest point of that pullback, it's right on that tail on the large chart, guys. This becomes a great study tool. And you had to ride out a little bit there, right? But it didn't matter. The market still went with all that momentum all the way to Fibonacci support. And I have no idea what the money increment is in feeder cattle. But guys, that's the pattern in feeder cattle. Whoops. Let me open up another one. Let's see if we can find another one. Let me get rid of my untitled workspace real quick. All right, so here is crude oil. That one had momentum. There's a tail. Oh, outside of the trigger lines. That's not a rules met. Let's see. Any crude oil trades this morning, guys? Looks like it back here. I'll tell you what, Jerry, these are the ones that you circled. Let's see what they look like. Let's see if they fit rules. So starting on the leftmost circle, pull back to support inside of triggers. I'd say that's a trade. Do you guys see it? The middle circle, pull back to support right in the retracement zone. I would say that's a trade. The first one, pull back to support right in the retracement zone. I would also say that's a trade. 3 opportunities. Does anyone feel like they could have made 2 or 3, $400 out of this one move between 2:14 and the end of the day? I feel like you could have. Are you trading copper better, Dad, or are you just curious about it? I've never even looked at copper. I'm not going to lie. Let's do it. It is HG. There it is, copper futures. We'll let it load up real quick. We'll get a small chart on there. And Jerry, it really does, because you realize that the next one's coming. And I think that's the biggest thing, is you recognize that the next trade is coming. 855, Jerry, or better, Dad? Somewhere right in here it looks like. 856, 855. Let's go back and look at it. Whoops. Pulls back. Second one makes it, and then a third divergence prints. So better, Dad, you might have gotten it at 88.70 and taken an exit because the third divergence. And then potential opportunities. Maybe right into a fib. And guys, I've never even looked at copper. I don't know how smooth it is. I don't have any frame of reference. But it's pretty cool, right? You can go through, and guys, you can do this on anything you're trading. And even if you have to adjust, fib to fib to fib to fib keeps you out of consolidation. Resistance breaks, behaves as support, right? Up here, back to support. These look pretty good. Let's take a look at these right here. There's one, odds favorable, clear path. There's two, odds favorable, clear path. So again, this is copper, guys. I've never in my life looked at copper. This one maybe didn't get you better, Dad, but that one sure did, didn't it? Isn't that beautiful? And it never blinked until all the way up there. So the patterns are the same. That's pretty cool. So maybe you don't have to know anything about the market. You just have to be able to recognize a pattern. Could it be that simple? Let's look. This has momentum and the potential to break. I wonder what it looked like. Maybe on the wrong side of things there. A little bit on the wrong side of things. But the one right before it, maybe. That's the S&P. They're cranking. Holy S&P, Batman. So guys, that's the first hour. That's what we talk about for the first hour. Every hour. So now I'm going to give you everything you need. And I'm even going to drop it. It's a zip file that's called All You Need. Inside the zip file, the first thing is going to be the Chart Reading 101. So this is just reminding you that you need to look at that large chart. Identify your momentum and path. Guys, this is the core of your education. And when you understand these two concepts, it opens the door for more opportunities. You're going to see those opportunities in the classroom as we look at other people's charts. So I encourage you, I don't demand because I can't make you want to be good at this, but I encourage you to take 25 pictures each and take the time to explain on the chart why the rule is met and what it means to you. Take 25 pictures of strong triggers and commit to odds favorable momentum. Take 25 pictures of weak triggers and commit to avoidance, abstinence when this is going on. Take pictures of a clear path, define it, take pictures of termination conditions. And guys, you can post all of these into this basic rules section. Come back and study it every morning until it becomes easy. So for you newer guys, I put it on there for you. Check it out. Strong triggers, rule 1, momentum. Strong triggers, rule 1, momentum. That's exactly what it looks like. You could take this same picture and go weak triggers. Anything can happen, and look at the reversal. Weak triggers, anything can happen. Look at the reversal. You could take the same picture, termination condition, termination condition, termination condition, termination condition. Guys, as a brand new user, you'll find more value in the pictures you take and annotate than you will the trades that you're full of adrenaline. So go through this drill, do a little study, ask a million questions. And as you're doing those pictures, if you want, go take pictures of strong tops and bottoms, because you're going to need this lesson when you get to your second trade. And it's just a termination that reverses the market. That's it. And the language is very specific. No triggers through termination that reverses the market. First, it's a termination. Then it becomes a strong top or bottom. This is the high probability trend trade checklist sheet. Do I have odds favorable momentum? That's momentum. That's weakness. Don't confuse the two. Do I have a clear path? Is it a termination condition? Does it only have the potential to break? Because I'm going to have to manage assertively. Learn these three and you'll be able to execute the trades on the plan that I'm giving you, defining your entry where the order goes, where the market should not. All of this is there for you as you go and take pictures. And then the second page is the trend trade checklist. And a lot of you use market replay to go back and test yourself. And Trina said it yesterday, so I want to give her praise for this one. Trina says that when she's doing market replay, she'll hit the pause button and look at her rules and make sure that the rules are actually met. Trina's not trying to market replay by memory. She's not taking hope trades or wish trades or want trades. She's taking the best trades. And Trina, I think that we could say without any hesitation that when you market replay and you actually follow the rules, the potential to make money is astronomical. It's pretty outstanding what you can do in a day. So guys, print this out, laminate it, use a dry erase marker, take your most delicious crayon, whatever you need to do, follow these rules, because nobody has ever followed these rules, all four, and done worse than 70%. And that brings me to the KISS plan. This is my baby. Purple ones, I agree, Morgan. Purple crayons are always the best crayons. This is the KISS plan, guys. Big disclaimer. This plan is a stepping stone in your learning journey. And I have to put that in there. Because a lot of times, and Jerry, you might be feeling this right now. A lot of times people say, man, but that high probability trend trade doesn't set up enough. I need to take some chances. The high probability trend trade doesn't give me enough opportunities. I need to break some rules if I'm ever going to make money. Guys, remember, this is the plan that teaches you to read your indicators. And this plan is designed to optimize your chances of success with that high probability trend trade as a new user, because it's pretty freaking amazing to be able to be profitable while you're learning your lessons. So through simulation, study, class feedback, and continuous practice, you will create a plan, guys. You're gonna create a plan based on your experience reading the indicators. DM me your address, Ron. I'll send you a sack of nickels. This is your first trade, and now here's where Ron gets his royalties. Guys, this is not your get-rich trade. This is the one that teaches you to recognize your get-rich trade. So if you're feeling like, oh my gosh, there's not enough opportunities, remember, you're learning and you're going to see more. Because there's two things that you have to know before you sit down and you're not on simulator. You need to know why you're going to enter a trade. I don't know about you guys, but my gut is wrong more often than it's not. So my answer is pretty standard. I'll enter a trade because my rules are met. Because my rules are nothing more than a description of a pattern. And that pattern's been proven to win more than it loses. And guys, if you take the time to verify and trust this pattern, there's no reason to not consistently enter when the rules are true. Because you never know what's going to happen in the market. But if you're trading a rules-based pattern, you have proven that it wins more than it loses, which means you have an edge every time you take it, and it's easier to accept the result. It pulls a lot of the emotion out of trading. But then you have to know why you're going to exit your trade. And guys, exits are taken at predetermined profit targets or when the advantages that got you into the trade go away. So what you're going to do is you're going to get into the market, maybe the high probability trend trade, and you know that if the market pushes beyond those trigger lines 4 or 5 ticks, your advantage has gone away, your edge is no longer present, and that becomes an exit. Or maybe 3 divergences print in the same price range in the middle of that trade, and you say, whoa, things are changing, my advantage is gone, I need to exit this trade. So in the very beginning, your entry is very if-then. It's very mechanical. It's very emotionless. If I have a termination that reverses the market, which isn't mandatory, but it gives me warm fuzzies, then I'll look for strong triggers. And if strong triggers are present, I'm going to make sure there's no termination conditions. And if I have none, well, I'm going to get in at the area inside of favorable large triggers without hesitation. And then once you're in the market, that's when the pucker factor hits, because now you have something to lose. So the management in the KISS plan is every bit as mechanical as the entries. Every bit. It is nothing but if then. And the KISS plan management is 2 contracts. It's designed to help you understand stop placement, and it's designed to get you focused on getting paid, because that's the goal. Better dad, if you have fibs on the small that are not on the large, it can be for a couple reasons. You may have corrupt data. You may need to make sure tick replay is activated. You might just need to reload the historical data. Will you show me a picture of the chart you're talking about? And then after I'm done with management, we'll go through. And guys, always remember, if you ever feel like there's a challenge on your charts, you don't ever have to hesitate. You can go straight to Jason in Tech and he'll get you. But the answer is yes. They should be represented on the large chart as well. It was the tick replay? Awesome. Easy fix. So guys, let's go through management. The KISS plan is based on 2 contracts, and it's dependent on your ability to understand the entry. So the entry, if the entry is 2 ticks below resistance inside of triggers, then the initial stop is 4 to 5 ticks beyond the triggers. This is where the market should not go. Guys, you're going to know your risk before you ever enter the trade. You're going to know how much you're risking, where your stop goes before you ever enter this trade. Targets are predefined at 100 and 200. Don't adjust them as a brand new user. Just let this thing play out. So your initial stop is $150 worth of risk. You have to be okay with that per contract. If you're like, well, that's just too much, I'll only give it 50, you put yourself below resistance inside of triggers. Well, I'll give it 70. You put yourself in the retracement zone. Guys, you have to be willing to put the stops where the market should not go. That's part of the advantage process. If they don't come and stop you out, they will 20 to 30% of the time. But if they don't, it means you're going to get that reversal bar in the direction of your trade. We call it a confirmation bar because it's confirming that the market is going down with the large chart trend. It's confirming that the market is going down with the large chart momentum. It's confirming that the market is going down with the large chart clear path. If I get the reversal bar, there's my if, then I'm going to redefine where the market should not go. 2 ticks above that reversal bar is where the market should not go. So now I have $30 of risk per contract as opposed to $150. It doesn't mean I'm going to win, but it means that if they come back and get me, it's a tiny little insignificant loser. But more often than not, they're going to hit your first target. With all of those advantages, more often than not, they're going to hit your first target. And if price reaches your first target, 1 contract is automatically removed. Those funds go into your account, guys. That's the success that breeds confidence. That's the win that dries up sweaty palms. That's the win that stops your heart from racing out of your chest. And here's the cool thing is you're going to move your stop to break even. So now you have no risk on this trade and profits have been taken. Is it the best stop? Maybe not. But what you're doing, guys, is you're focused on getting paid. You're focused on accumulating wealth instead of hoping the market provides it. So if you don't get stopped out break even, it's going to go to your second target, $200 predetermined, which means that's a $300 trade. And that $300 trade, if that's the best you do every day, is 75 grand a year. Pre-taxed, assuming 252 trading days. Nobody in this room is going to be bummed about an extra 75 grand a year. You would be crazy to, right? That's one trade. That's 4 minutes. 4 minutes. Catch it twice. 150, right? One of them's break even. It's 100. Guys, use a trade copier. Take that same one trade on 3 accounts. Get up to $250,000. The idea is that daily profits reached consistently. is what reaches long-term goals. And that word consistently is key, guys. Doing the same thing every day because it provides an edge, because it provides an advantage. Understanding that the market doesn't give two shits about your opinion. Pardon my French. The market doesn't care if you have mortgage due or if the kids have to go to college. The market doesn't care if you want a new car. So we take the trades that have been proven to win more than they lose, because that's how you get to where you want to be. Learning how to get paid, understanding that you don't have to make it all in a day. So that everything, that all you need zip file has everything that I just showed you guys, including the PowerPoint that I used to teach the room. And what we're going to do is we're going to get into our second hour and we're going to start doing feedback. Good morning, Miss Trina. And we're going to start the feedback process on everything that's presented. So I want to share this with the new users because I think this is really important as we get into seeing trades that are not high probability trades. Guys, the key to everything is having a foundation. So Lonnie, if this is day one for you, it's going to be a little overwhelming until about day 3, and then things are going to kick in. And once, like by the end of the week, you're like, oh my gosh, this all makes sense. So we're building a foundation and we're understanding the basics. And guys, every day we're going to get 1% better. Every day we're going to get a little bit better. We're going to see things a little more clearly. So for you brand new users, I blanket you with very conservative rules, with the recognition of advantages. I hand you a solid plan that optimizes your chances of success as a brand new user. And for you brand new users, it feels like every termination condition is a death sentence, and no momentum is the worst thing you can do, and areas not inside of triggers should be avoided like the plague. And I give you these blanket rules because it increases your likelihood of success as a brand new user. You're more likely to stick around, to find success, if you keep it very simple in the beginning. And then eventually, just like anything, the more time with it, the more you'll see. So learn the process that yields the results. The process is momentum, path, and entry. Learn the process. That's where the KISS plan comes in. If you keep it that basic, if you follow simple rules, if you're okay not looking for all the trades, only the best trades, you can, and people have, found an extraordinary level of success. I've watched it repeatedly over the years, guys. So the further new users deviate from simple, the longer they tend to take to be comfortable in pattern recognition. The more you look for, the less you seem to find. It's the craziest thing. So question everything. As we get into the second hour, if I click on a chart and it doesn't make sense, feel free to ask a question. If I look at your chart and you don't think I read your chart correctly, ask a question. I want you to learn. I want you to question everything. I want you to be a little suspicious, and I want you to do the work to prove that this either does or does not work for you. But, and this is for my wife, give yourself a little grace, guys. You are brand new. You are starting something new. You're at the beginning of a journey and you will make mistakes. And it's okay. It's okay to make mistakes, but I'm going to tell you, if you show me what you're doing, if you tell me what you're doing, if you illustrate the whys in text, we can fix your mistakes. I can give you a plan to fix your mistakes. We can identify them, the patterns that are robbing you of success, and we'll work together to get you to where you want to be. So when I talk about writing the why on a chart, every time you do that, you're creating a recipe and you're making things repeatable. So the whys aren't for me. I can look at anybody's chart in this room. I can tell you exactly what's going on. I can tell you exactly where the best entry was. I can tell you exactly where the best exits are. Your whys are for you when you go back and study, because you're going to hear your voice saying that when I have strong triggers and there's the potential to break, I want to be in at the area inside the triggers. I want to hold it up to that divergence line. I want to make this money, because that's the pattern where the edge is. So I'm going to take a break. I'm going to take 5 minutes. I'm going to go stretch my legs. You just had momentum and path, pull back to resistance inside of triggers, and now 3 divergences printed in the same location. And it seems as though that market's trying to push up. Pretty crazy, right? Here you had momentum. You had the potential to break. And guys, it didn't break, it retraced. It did give you a reversal bar. Maybe you took a smaller loss if you tried that trade. But then it came right back and gave you beauty to go finish. So, guys, I'm going to take a break. When I come back, we're going to look at your charts. Remember, if you have a question, ask it. If you have a problem, let me try to fix it. If you need feedback, awesome. Just tell me why you did what you did. I'll see you guys in 5 minutes. Get that second half going. So just a reminder is I have to scroll up to the top, and this is where I find all your pictures. So I do go back and forth. I scroll up, I see them, I scroll down. So if I ever miss a picture, guys, just tell me. Go, hey, Mark, at 8:25, you missed a picture. I could use a little feedback. I'll always get you. We're going to start with Andy this morning, and Andy says, check it out. I'm trading the RTY. I had odds favorable momentum. I had the potential to break. I took the entry a little bit early to make sure I didn't miss it, but I knew where my stop goes. I knew where the better entry was. And then Andy, beautiful. You take it all the way up to the fib. And the only thing, and guys, I want you to see how Andy did this. Andy gets paid on the way up to the area that could stop the market. And he's like, you know what? Let me take most of my investment off, but we'll leave one on there to see if it runs, to see if it breaks. And Andy, when you had weak triggers directly into a fib, it's less likely to break. But great trade. Great trade. A little early on the entry, but you knew where the best one was. Nicely done. Cav. S&P is not as fast as the NASDAQ. I agree. So at 8:33, you're trading right after news. And it looks like you were trading momentum directly into a termination condition, fighting the gap theory, and you got lucky, Cav. You traded directly into not only a termination condition, but also the gap theory. But I like that you get it on the way up because of the momentum, and you manage aggressively because you know the trouble. And guys, that's the beauty, is when you start talking to yourself in terms of advantages. Cav says, man, this thing is screaming so fast. There's no divergence. I don't know if this is going to hold. Yeah, but Cav, you've never sent me a check, so your 20 ticks means nothing to me, right? My job is to talk about the momentum is overwhelmingly beautiful. The termination is very, very real. You didn't get in on the way down, you got in on the way up, which means that you knew exactly what you were up against. It gave you the ability to have a very minimal risk trade to allow momentum to retest the area, and you knew exactly where the retest was likely to happen, and that's where you took profit. So from a classroom standpoint, I gotta say, dag nabbit, Cav, you traded into a termination condition. But from a chart reading, from a weighing advantages versus disadvantages, using your ability to read charts to take a great low risk entry and to manage it aggressively, then it's gold stars all around. So if you're a brand new user, you're thinking, oh man, he broke rules. But if you're an experienced user, you're like, wow, that was like masterful use of a rule break. You don't have to break your rules, but you'll get to the point to where you'll be able to make exceptions based on your ability to read indicators. Kind of cool how that works, right? You'll be empowered to craft a plan based on your ability to read the indicators. And Cav, I'm not knocking you on the $20 tick profit thing, but guys, if you associate your wins with the correct trades, it bites you in the ass eventually. Because I can get lucky all day long and make a bunch of money, and the second I go live, it seems to run out. Pivot from divergence. No, the pivot caused divergence, not from divergence. Divergence wasn't true until here, but you have odds favorable. And I love this. Guys, look at his chart. So the first one, he's in a little early, directly into the area, not from the area, but he rides the bounce because of the momentum, gets out of trouble, and then takes the trend trade. And that's the one that runs. Nice trading. Yeah, that's pretty common. Guys, these things create bounces. Trading directly into a fib, trading directly into a one-to-one, it's so much easier to let them break, but it means you have to be patient. And it sucks to be patient. It means that you're not in the market. It means you're not doing anything. And that really affects people's brains. They're like, oh, if I'm not in the market, I'm not making money. And if I'm not making money in this 3-second period, what on earth am I going to do? Trust me, I know. From a strong top, not the best momentum. To the tick, only 3 of your 4 lots were filled. That happens sometimes. And then beautiful target. Nicely done. Great job, Andy. When everything says down, when every indicator agrees, guys, it's hard for the market to go up. A lot of you find a way to capitalize on that. Boaz, your trigger lines are wonky, just so you know. I would refresh data. Pivot, stop out, strong top. When it only fills part, it usually goes to your target. Yeah, Murphy's Law, right? Momentum, potential to break. You're in right at the area. It is on the wrong side of the triggers, and sure enough, it goes up a little bit. But you get out at trouble. Nicely done. Nicely done, Boaz. I'm not sure where your stop was, because your entry was 4 or 5 ticks beyond the triggers. So I'm guessing you used Fibonacci resistance and said with all these triggers down and momentum strong, that fib is more likely to stop the market than it is to just smash through. Nicely done. Great trade. Little outside, right? Little outside of the rules, but still momentum. Momentum for the win. I love it. Great job. Joel. 3 divergences in the same area. All right, so we're going to address this one. Let me take a big old picture. This is awesome. Guys, this is, my rules say that's a termination condition. But one of the great things about this classroom is, guys, sometimes we misunderstand rules. Sometimes we need to learn a new way to think about it. So I'm going to extend this divergence out. The first divergence I'm going to extend out all the way to the end. And does everybody see how the small and the large triggers get below that divergence? So when we talk about broken areas, if small and large break below divergence line, it resets the count. So once they got below this one, Joel, then we let this one be our first divergence, and this one becomes your second divergence. Does that make sense, everybody? The ideas on 3 divergences in the same price range is the same idea of broken areas. Once smalls and large get below, rear view mirror. I love it. I do too, Joel. Every day. Good stuff. All right, who's next? Guys, not a lot of pictures today. Bob, be the man. All right, let's see. Strong bottom. I like it. There is definitely odds favorable momentum down here. 25 points from where you got in. You get a pivot from triggers. Strong bottom again. Not odds favorable, but it's on its way up from the strong bottom. Then it becomes odds favorable and not quite a clear path. Trying to figure out everything you did. So all of this annotation, you take that chili dog look and you capitalize on the way up. And that's this stretch right here. You get in above trouble with momentum and just ride it up. Absolutely beautiful, Bob. And then you've got strong trending market and a clear path. You let it pull back to the fib with every trigger screaming up. This is very much like what we saw on Boaz when he took the short. If everything on your large chart is screaming in the direction and it pulls back to a fib with everything above it, The recipe for termination conditions. Guys, watch how Bob reverse engineered this. Let me take the picture. Because this is heads up stuff, Bob. If price reaches Fibonacci resistance and all the triggers are above it, don't we automatically use the language, resistance is likely to stop the market? Or support, actually, in this case. So he uses the idea of termination conditions, but with every indicator going up, he uses it as an opportunity to take the long trade and to go up, and it's absolutely beautiful, Bob. And this is awesome trading. You never had a reason to exit your momentum trade until you get the reversal bar. And then it just turns into a trend trade from the wrong side of triggers, but using your chart read to take the entry. I like it. Really nicely done. You are catching some major mojo flow with your chart reading and your execution. Gary, you say trend trade ES. I don't know where you got in, dude. Gary, do me a favor. Just for grins, when you post a trend trade, help me out a little bit. Circle something, maybe? I'm assuming you got in right here with the momentum and path. It's really hard to read because you're making me ignore a bunch of stuff in the middle. And it's not a trend trade. You jumped in on the way down, but I like it. So you jump in on the way down, and then it hits Fibonacci support, and you give a lot back. It's a good look on the large chart, I'm assuming. It's very difficult to read, though, Gary, because these two have nothing to do with anything, and it's hard to line up your entry with the large chart. If you'd put a big circle or something on there, that would help me a lot. It would help the people in the room a lot for educational purposes. Guys, this is the chili dog. You know, Ron, you'll get a kick out of this. This morning, my brother, we're watching the NASDAQ together, and John goes, "Oop, chili dog." Even John knows your rules. Odds favorable momentum. Nothing in the way. Find a way to capitalize. Base hit. That's it. Base hit. You even got John recognizing chili dogs now. And then, guys, the traders that do the same thing over and over, these are the people that tend to be the most successful. The people that take the same entries, the same management. Odds favorable. Back of price clears trouble. Everything says down. Rodeo base hit. 8 seconds. Guys, these are the men and women that are finding success. The people where all their charts look exactly the same. Great execution, Ron. Gary, I need wise, brother. I know that you want it. I know that you're posted. It says pullback trend trade. I don't know which trend you're with. And you didn't pull back to anything. And I like that you took exits at trouble. So guys, one of the things with this class, and Gary, I'm not beating you up, and I sure hope it doesn't feel that way. Guys, if you don't tell me why, if you don't show me where, and you don't tell me why you're doing what you're doing, you're not asking for feedback. You're putting a picture on grandma's refrigerator. And that's cool. I want to celebrate your victories, but from a classroom standpoint, that's not very conducive to education. Cav, strong bottom, odds favorable, clear path, You had a limit order at the fib, but it didn't get there. So with everything up, you hop in and get out at the mid-band. Great job, Cav. Just taking advantage of a little bit of momentum. Nicely done. I do love momentum and path, guys. Momentum and path. Makes dreams come true. 56.11.85, 56.11.85. Momentum, path. You're on the wrong side, so I'm not sure how you picked your stops, and that's the only thing I can say about this one. Odds favorable, clear path. All your areas are on the wrong side. So thank goodness it didn't go up to this fib or this mid-band or reverse. But beautiful, makes it down to the next Fibonacci area. When I'm on the wrong side of triggers, and Cav knows this, guys, the entry's not perfect. I don't know if or where the market's going to stop once I get to the other side. Using that reversal bar for entry tends to avoid a lot of losers. But once Cav hits his goals in the morning, one thing he does is he goes to simulator and he practices concepts. And I love it. He's like, I don't really have any real risk. Let me see if I can find a way to do it better. Andy, price can't keep up with the triggers. Yeah, you want to reload historical data when it looks like this, for sure. But you were maybe 50-50 on a divergence high. It looks like you had the best momentum ever. Your entry is on the wrong side of everything. Thank goodness it worked. And with all that momentum, it goes up to the second target. Nicely done. Gary, you called that top step goal matrix, daily goal matrix. I like it. Boaz, let's see what we have. We looked at this one. Odds favorable, potential to break. You get in on the wrong side of the triggers, and it bounces right off the top of the triggers and continues up. And guys, this is one of the lessons. This is one of the reasons why I think language is so important. Once you're on the wrong side, guys, there's no telling. Once you're on the wrong side of those large triggers, there's no telling if it's going to stop. And you can do whatever you want. But when you start entering on the wrong side, you run the risk of this happening. It becomes much greater. It is much more likely to ruin your day than it is to give you warm, fuzzy feelings once you get in on the wrong side of those triggers, guys. Odds favorable, yep. Clear path, yep. First target hit, break even on the second. I like it. Josh, can we talk about management a little bit? And it might have just been in the moment. So there's your first target. Once that third divergence prints, man, no reason to give it up break even. Once that third divergence prints, man, there's just no reason to give that money back, because that's the one, right? That's the one that could stop it, that could kill it. And it takes some quick reaction time. It really does. Right on. It's so easy for me when the charts aren't moving. It's so easy for me when the charts aren't moving to say stuff like that, guys. And that's where the repetition creates so many advantages, is you begin to see these things faster. Yeah, someone said that once. Someone goes, man, Mark, you nail everything when you look at a chart. Well, no kidding. It's not moving. I could hand any one of you the microphone, and you could do the chart read. You can go back without the adrenaline, with no fear of loss, and do the chart read. All right, Miss Cindy. Strong triggers, potential to break, pulls back right to resistance inside of triggers. You get the first target, and then you could have moved the second, but it was so darn fast you couldn't. What a great problem to have, Cindy. What a great problem to have. The market was so fast they hit my targets before I could make bigger targets. I'm sorry, I just don't think I could ever get mad about that. All right, Ed. Ed, you know the rules, brother. Fear of missing out entry. Lost. Take the second one, and then you don't believe it when everything's going down. What'd your large chart say? Your large chart synthetics were up. Your small chart large triggers were up. Nothing said down yet, and everything's above fibs, and you went short, and it bounced. I'll be darned. And then when it rolled, you got it. So Ed, for the sake of the classroom, and I hate to be a nag. Actually, that's not true. I don't hate to be a nag at all, guys, because this classroom is important to everybody. I'll give you 1,000,000 pounds of feedback, but I need 2 charts, and I need to know why. What did the large chart say that made you went short? Or was it just, oh my gosh, I haven't traded in 5 minutes, I better get into the market, right? Jen, term, no trade into a fib, but Jen, it's not there yet. That's a potential 50-50 from a strong bottom. And then it's a potential to break, and then it's a termination, and then it's a termination. And this one is the same look, Jen. This one's the same look. This is a 50-50 that makes it to the fib. This is a 50-50 that makes it to the fib. I'm not sure what it looked like real time. But in hindsight, when I am my absolute most brilliant, it looks like you had room to get back to the termination condition. That's okay. Andy, everything says up with momentum. You get in on the wrong side of the triggers, survive the retracement, and off it goes. So I like it. And man, I don't know which synthetics you have on your NASDAQ over here, but I do know that the Ale rules say reversal bar gets you in. This fights a lot. It's so much easier when you're on the wrong side of everything, Andy. So Jen, go back and circle those. We'll go back and circle those. And let's see what it looked like in the grand scheme of things. Strong bottom, odds favorable, not a clear path. I sure will, Boaz. So I like this one. So Bob B is saying, check this out. Check this out. I've got the bottom, I've got momentum, but my path isn't perfect. My path isn't what I want it to be. Look what Bob did. He didn't trade directly into the fib hoping that it broke. He waited for the reaction and then took the Nexgen momentum trade with the potential to break and rode it all the way up. Bob, this is gorgeous. It's that little bit of patience that pulls one of the losers out of the mix and lets you keep the money from the winner. Great job on that one, Bob. All right, so wrong side of the triggers. Let's go find a chart. Just gonna find a good look. All right. Give me 1 second. I'm trying to find one that kind of illustrates how things can go wrong. All right, so here's a good example. And let me see what it looked like over here at 717. (6:30, 7 a.m.), maybe somewhere. All right, so you ready, Boaz? And I'm not sure where this is. Maybe I'm a day back. No. Let me see if it's over here. I want to see the whole look. All right, so this is it right here. So Boaz, everything says up. This is a great example. The path is clear. It's a strong trending market. And you go through the process of defining entry. So the rules say the first thing you do at the time of the reversal bar is you identify the top of the triggers to the bottom of the triggers. And we'll just do that right there. So there's your triggers. And then there's no areas inside of it, right? There's no fibs, there's no mid bands, there's no yellow one-to-ones. So the wrong side of the triggers, remember that the trigger lines define where the retracement is most likely to go. But it's the areas inside that define where the bounce is most likely to happen. And all of your bounce points, that's the wrong side, that's the wrong side, that's the wrong side, this. You don't know where it's going to stop. So if you arbitrarily jump in here, you probably get run over. If you say, well, it has to go from here, you may get run over again. But Boaz, with the large chart look, if you wait for the confirmation bar, then you get to ride that strong trending market up to the next fib. So when I say the wrong side of the triggers, I'm referring to being below where the retracement is most likely to occur, below where the bounce, which is the areas inside of triggers, is most likely to occur, and it becomes a crapshoot. You just don't know which one's going to stop it, or if it's going to stop it. Does that make sense? Great question. And that's why rule number 3, guys, why I harp on language so much. Area inside of triggers. Because that's where the advantages come in. All right, Miss Trina. Weak because the triggers are through. Odds favorable, wide open. Everything's going up. Clear path to the termination. Price pulls back to support right inside of triggers. And it stops you out. What'd you do wrong, Trina? What rule did you break? None. Amen. Trina, this is the cost of doing business. This is that 20 to 30%. This is the perfect trade. It's a beautiful trade. You have all the advantages. It just didn't work. So the question I ask new users, would you take this entry again if it's set up? Or would you let this loss keep you out of the next perfect trade? Because we're developing trust. And Trina, I would lose that trade with you all day long. And your stop is beautiful. To lose $175 on 2 contracts, that's some low risk futures trading. Nicely done. Love everything about that one. Odds favorable, clear path, perfect entry, stop makes sense. So Ed, the only thing that went wrong with this trade is, if I'm not mistaken, there were 3 divergences from the low. You got in after the 3rd one. But again, this doesn't tell me anything other than you think it's stupid. You can't even see where it's coming from. So we're just going to say, you're right, Ed. Damn market. Damn market. But you had the right idea, Ed. Large chart look is amazing. Small chart gave you the heads up that maybe it was going to go a little higher. All right, Jerry, you said so much for waiting for high probability trend trade. Let's see what we have. Odds favorable, Everything says up. You're in after the pullback. There to there in less than a minute. Woo, that's fast. So here's the question. How did you get stopped out at 2 ticks? Did it start to go and you got scared? Let me lock in all my money? Which is normal. At the magenta, a big pullback. That's not a big pullback. So Jerry, this is a 5-1. That's less than 10 ticks. That's not a big pullback. So let's talk chili dog. And I like that you're trying to do it. Wanted to keep the money. That's okay. That $20 feels good, right? Not nearly as good as the 200 would have felt. That's okay. You're working through. You're working through right now. So let's talk about everything that happened here. Termination reverses the market. Odds favorable. So Jerry, your entry is actually your exit. Because when the small triggers break through the fib, right here, it's 67.37. That's the Nexgen momentum trade. The chili dog hasn't set up yet. In order for the chili dog to set up, and let's just go through it. Guys, the chili dog is not a Nexgen trade. The back of the bar has to clear everything. That's where the chili dog is. Which means that the market is trading all the way up here at 50, which means you don't have any room to make money. What you took was the Nexgen momentum trade, which says that when you have this level of momentum on the large chart and the small triggers break through the fib, you're going to buy a snapback to the fib and you're going to ride that momentum either up to the next key area or until momentum fails. Does that make sense, Jerry? So a little misunderstanding of the rules here, but honestly, your exit was almost perfect execution of the Nexgen momentum trade. And this is what happens when you start adding trades. And I'm not trying to discourage you from adding trades because I know you want to be busy. But now you're working on rules for 2 different trades with different looks, with different management. Simplicity pays dividends. It really does. And you see how the back of the bar never cleared the fibs up here? So even with the momentum, you would have never taken a chili dog here. I liked where your thinking was, though, because your thinking was, look at the momentum. I'm on the other side of the fib. I love everything about it. Now you just have to trust it a little bit. Take whatever entry you want. Let me give you some cool pictures that'll help. Yeah, because a lot of people were taking these trades. And Jerry, this is what I would call the JTFI trade. You just jump the fudge in because of momentum. You don't have to use the word fudge. I will because it's a PG-13 room. But let me show you something pretty cool and how it pertains to this picture. You use fudge and it still got you on there. So if I just jump in with the momentum, Jerry, that market is going to continue down until I get a close on the wrong side of the triggers. And if I just jump in here, that market's going to continue down until I get a close on the other side of the triggers. And the same is true here. If I just jump in, the market's not going to go down until I get a close on the wrong side of the triggers. And this is a pretty basic concept, but you can use it to help you manage these trades. So check it out. You get in with all that momentum, and your momentum doesn't stop. The market doesn't even blink until it gets to the wrong side of those triggers. Does that make sense? And I love this look. because I love the look on your charts, man. You've got the termination, you've got all the momentum, you were patient to wait for the fib. And I think that if we would have talked about this yesterday, you probably would have made money on this trade instead of just covering your commissions. Does that make, I hope that makes sense. So it's cool. We talk about this about once every couple of weeks. But there it is again. Once we get to the left side of those small triggers, it doesn't stop until you get a pullback. And once you get to the right side of those triggers, it doesn't stop until you get the pullback. So we use the clear path, and I think this was it right here. There's the momentum trade, and you just use it until you lose momentum. Your head was 100% in the right place. 100% in the right place, Jerry. Just a little management, so I dig it. Ed, pivot stop out, reverses the market, everything starts up. You chose to trade into the termination condition. You didn't really have any room. That's the challenge, Ed, and that's probably why this one freaked you out, is you knew you didn't have any room. So you're probably not going to get a management lesson trading into a termination. Your entry's awesome. So Ed, maybe we can use that same idea. If it doesn't close on the wrong side of the triggers, it's going to keep going up. But the problem is you guys keep moving your stops to protect 2 ticks on a small, tiny little chart. It just doesn't work. Check this out. And Ed, I hope you're looking. Guys, if you went short right here for whatever reason, there were 3 opportunities for this market to scare the shit out of you and take you out of the trade. But it didn't start going up until the reversal bar. Nothing changed until the reversal bar, and then that's just a momentum trade. Could have faked you out. If you got in here, you protect profits, it takes you right out of it, but the market doesn't go down until it gets to the other side. There's a tail. There's a tail. Guys, these are tiny little charts. Ed, does that make sense? You and Jerry did the exact same thing. You just tighten up too fast. So one of the things about day trading, losses happen, guys. And when you put your stop, and when you move it arbitrarily to lock in profits, it's like they have cameras. It's like they know. And they tap it and they just run. And then you get pissed off and you start taking the wrong trades. But Ed, if you had just taken the pullback to support inside of triggers here, why did you miss this one? Because that one's perfect. We get bored and take the aggressive ones, and it keeps us from catching the right ones. The market is out to get you. That's why we trade patterns that have been proven to win more than they lose. And then Jerry, Ron was nice enough to post in the room there. Those are the rules for the chili dog. Right there. So if you're looking to study the chili dog, there's the picture. And then just one more. There's my study on the chili dog. And it's just it's a Word doc, but you'll notice at the very top of it is the exact same picture. So Ron, thank you for that. Guys, nobody is ever obligated to share their plan in this room, and Ron does, and it's pretty cool that he does. So for you guys that are just jumping in, remember, as long as it doesn't close on the wrong side of those triggers, it's going to go in the direction it's going. All right, Joel, strong bottom, odds favorable, clear path, perfect entry, Didn't work. Why do you need to work on management, Joel? You're about 4 or 5 ticks below the triggers. What do you feel like you messed up on management? I think you did it perfect. But again, I'm going to go back to this. That's a good look. That was Ed's long. That's a good look. This one I think is aggressive. Hard to find rules, Matt. That's a great looking trend trade. That's a great looking trend trade. This one worked. This one didn't. Good stuff though, Joel. What does your management plan say? I want to address that. What does your management plan say? Does it say 4 or 5 ticks below the triggers? Is it that KISS plan management, 4 or 5 ticks below the triggers, wait for a reversal bar, reduce risk? Yes? So guys, one of the things you're going to do is you're going to do everything perfect. But because it doesn't win, you're going to take a shot at yourself. You're going to try and beat yourself up. You're going to say, oh, I effed it all up. Joel, you did everything perfect. Everything perfect. From entry to management to the look on the chart, there's nothing wrong with this. So I'm going to tell you, Joel, great job. Awesome job. Beautiful job. You did it great. There's your gold star. Don't beat yourself up. Go back to the rules. And I think that's one of the greatest things you can do when you go back and look at your own charts, guys. Instead of saying, oh, I lost, I must have sucked. Say, did I have my rules met? And Joel, 100%. Did I follow my management plan? 100%. Joel, you followed the plan that optimizes your chances of success. I love it. And you know what the cool thing is you're not the only one that saw it and managed it like that. Which means there's more than one of you doing trades per the plan. And sometimes they don't work. Loss is never failure, guys. Loss is never failure. Loss is an opportunity to get better, and sometimes it's a cost of doing business. Good stuff. All right, guys, we made it through the second hour. I'm going to go take a break. I'm out of pictures, and I love it. There's 37 people in this room that have the opportunity to post, to ask a question, to get feedback. So take advantage of it, guys. This is live, 15 hours every week. Take advantage of it. Drop them in the room, Better Dad. I can't wait. And if you're like Better Dad, and you got a bunch, post them. I want to see every one of them because there's a lot of great lessons in those. I'll be back in about 3 or 4 minutes. When I come back, we're going to finish strong today, guys. See you in a few. All right, guys, let's get going. So, Jim, I think you're confusing two different lessons. So let's talk about this. 4 to 5 ticks below where the market should go, right? 4 to 5 ticks below triggers. Let me reload my historical data here. Sometimes it overruns, Jim. So in the basic high probability trend trade, and this is feeder cattle again, because I like this market. It tends to be super smooth. 4 to 5 ticks keeps you safe once again. And you're saying, what if you never get a reversal bar? Well, Jim, you're not getting in on the reversal bar. And I never said that the reversal bar reduces risk. Jim, the reversal bar gives you some place to put your stop. So let's take this picture. Jim, maybe I don't want to get in at the area inside of triggers, right? Maybe you say, I'm going to wait for a confirmation bar. Are you with me, Jim? Are you in here? You can't stir the pot and run. The rules-based entry is right here at the area inside of triggers, and it looks like the stop keeps you safe. 4 to 5 ticks below the triggers where the market shouldn't go, it misses you. If you wait for a confirmation bar, the stop's pretty much in the same place, Jim. It doesn't reduce risk at all. You actually have more risk. But what you do have is confirmation. So the idea of the confirmation bar, and let me see if I can find an example. I'll show you exactly what. So here's a good example right here at 1303. Maybe you're looking for the short trade, right, Jim? And the market's already beyond. You're saying, man, my large chart says down, my large chart has a clear path, life is freaking amazing, but my entry isn't perfect. I'm on the wrong side of the triggers. So, Jim, I talk about using a reversal bar when your entry isn't perfect, because if you wait for the reversal bar, well, now you have some place to put your stop, 2 ticks above it, and it's also confirming that the market's going in the direction of the overall trend. So, Jim, if you never get the reversal bar, you never take the trade. So the idea of a confirmation bar is when the entry isn't perfect. It's not designed to reduce risk. It's designed to establish risk, to define where the market should not go. So if you have the perfect trade, let's go look at this one. And here's a great example. If you get in at the lowest area inside of triggers and you say, well, it's just too much risk to put my stop where the market shouldn't go, you risk getting run over if it goes to the top of those triggers. So if you're not comfortable with the risk from here, you can say, I'll get in later, or you can say, I'll take the confirmation bar because then I've got something to put my stop behind. Does that make sense, Jim? There's no reason to wait for confirmation if everything's perfect. But if you do wait for confirmation, all it does is it gives you some place to put your stop. And you're absolutely right. If the entry isn't perfect and you never get a reversal bar, let's see over here. Nope, that one stayed in at 2. But if the entry isn't perfect, let's see if we can find one that maybe got run over. I like finding, okay, so let's say this one right in the middle of the night. This is a good example. If you're like, I'm going to wait for confirmation because it's not a clear path or whatever, if you never get it, then you're all good. Boaz, you've got to put spaces in between your links. The market is reading this as one, or my internet's reading this as one ginormous link. I hope that made sense, Jim. I think you're absolutely right. If it's not perfect, you can wait for confirmation. It doesn't necessarily reduce risk. You pay a price for that confirmation. You might get in further away from the best spot. Boaz, it won't even let me. I'm trying to see if I can pull one over on it. Until the stop gets hit, Jim. Absolutely. And the reason is, and the reason that's a thing, Jim, and that's where the trust comes in. That's where you have to study. That's where you have to believe that with this look, it's going to win more than it loses. And that's why rules are so important. I'm glad you put that in there. Why am I willing to put a stop 4 or 5 ticks beyond the triggers? Why am I willing to let the market hit that stop? Because, Jim, with this look, more often than not, it goes up. More often than not. Not always, but more often than not. So once I'm 4 or 5 ticks below everything, my advantage is gone, and that's why I exit the trade. Does that make sense, Jim? So if you're in some crazy asinine risky trade, it doesn't make sense to have that much risk. But yeah, on something like this, my brother used to say that. They're going to have to come and get me. I'm not going to offer myself up. They're going to have to come and get me. They're going to have to come and get my stop. I'm not going to give them money with this look because they're more likely to go up than down. That's a great question. And then Boaz, I hope you're listening. Can you repost with spaces in between? And guys, here's a gentleman that understands how to take advantage of the class. 11 pictures. Boaz, I did get your first one, but I don't want to go through and delete every one of them. But there it is. Check it out. 3 divergences, strong triggers, potential to break, beautiful entry, and off it goes. And Boaz, this is gorgeous. Beautiful, beautiful trade. All right, Better Dad. Odds favorable since the smalls are below the large. Weak top since the triggers are through. Clear path after the large roll to red. So we're going to test your clear path theory. Where is your entry? Stop loss here and here again. Entry 2 ticks below the midband and you got stopped out. Catch it again on the reversal bar since the large chart says go. So 580, 580. Do you see, Better Dad, how you traded directly into a termination condition? Price reached Fibonacci support and none of the triggers broke. Does that make sense? It had a lot to do with why you got such an aggressive bounce. I like your first entry. It just didn't work. And then you get in with a confirmation saying everything says down. And then it works out pretty well, even into the termination, because of the momentum. Good one. But I like to point out just the tail. So here's the deal. I'm glad you said that. Stop worrying about the tail. And let me show you why. The tail is a large chart, slow moving, who knows where it's going to happen thing, Better Dad. The area inside of triggers, this defines where the tail is most likely. So once you have your large chart rules met, go to the small chart, let it define it. And one of the things that you'll notice is that there's a pretty good gap in between the triggers. The midband's floating in the middle. There is a termination condition, right? There's a lot wrong with this one. And then you nailed it waiting for confirmation. It wasn't the perfect trade, but with confirmation and all that momentum, it becomes easier. Waiting for the confirmation is the hard part. But don't wait for the tail to form. Just one mistake. You know in the morning when I say that momentum covers mistakes? Momentum covers mistakes. Your triggers are wonky again. Weak top, clear path but wasn't paying attention. Odds favorable, clear path again, pulls right back to resistance, easy money. Nice job. Smalls and large below the fib, pulls right back to the fib inside of triggers, easy money. Great trade there. And I like that you take the time to type that followed rules feels good. All right, better dad. Weak bottoms. Well, price pulled back to yellow 1-to-1s. All the triggers remained above. This is a strong bottom right here, better dad. You have odds favorable. Large clear divergence. The path is clear. Oh, wait a minute. Are you ready, better dad? So Jim, maybe this one helps you as well. Let me read everything. Entered 2 ticks above the mid band, but bad trade since the mid band wasn't in the trade window. And then it got you. I like this. But the large chart still said go. So with confirmation, because it's on the wrong side of the triggers, it's pretty easy. And you take profits and get out break even on the second. Does that make sense to you guys? Once your areas are on the wrong side of the triggers, you don't know if or when it's going to stop. Trigger lines don't create bounces. Better dad, that's the one that I want you to get out of this. Trigger lines don't create bounces. Areas inside of trigger lines create bounces. So this was a great one to wait for it to head back up. That's the Wayne entry. Nice job, better dad. And that's where language pays dividends. Again, if every time you take an entry, you use that phrase, area inside. Inside. No, you're doing great. Yeah, nickel for Wayne. You're doing great. Odds favorable, potential to break. Got excited, did not have a clear path. Didn't wait for the area inside of triggers. And took a huge loss. Entered 2 ticks below the 1-to-1. Hold on. And you just got run over. So, better dad, when it only has the potential to break, this right here is a killer. Divergence is a killer. And I love 50-50 trades. I love the potential to break trades, better dad. But if you go to the KISS plan, as soon as you identify it as a medium probability, only the potential to break, rule number 1 is a strong top, which you don't have. And the thing that's repeated 3 times in the KISS plan is divergence kills them. Divergence kills them. Divergence. No, don't kick yourself. Because you had the courage to post it, you took it, you annotated it, and you're taking the feedback, which means next time this sets up, you're going to hear my nagging voice. Better dad. Look at how much is against it. Ever tell you guys a story that when I was a personal trainer, I actually had a guy's wife call me, and I answered the phone because I recognized his number, and I'm like, hello? And for like 5 times straight, Mark said, Mark said, Mark said, Mark said, and I'm like, who the hell is this? And it's the guy's wife. She goes, I'm so tired of hearing my husband say Mark said. And I was laughing so hard because eventually you listen to me because you get tired of the nagging. So odds favorable, smalls above the large, everything says up, the path is clear. Let's see what happens. Price pulls right back to the wrong side, and you get in on the way up, getting in on the right side. I love it. Yeah, I agree. I think there's more to learn from losers than there are winners. But look at this. You've already taken the lesson. Everything's perfect, but there's no areas inside. So you choose to get in on the way up, and yeah, it slipped you a lot. And then it pulls back to the fib again, and then you get paid. Still like the losing look, but losing on odds favorable on the large chart. So let me see. You get in up here, and then it takes you out, I guess, which is right here. Yeah. 2 ticks below the bar that gets you in, below the reversal bar. This is a weird look because you've got to manage risk differently when you get slipped all the way up here. And then the second one, you take it right above. Not sure why it didn't get you, but it worked out. Got skittish, close it here manually, would have hit profit target. Still like the look, losing odds favorable on the large chart. I mean, it's still a rules-based trade. It did come all the way down. So, better dad, the only thing I can say on this one is 1, 2, 3 divergences in the same price range. And look how it pushed down lower outside of those triggers. And then it heads back up. But 1, 2, 3 divergences is that termination condition. And you can see how the buyers and sellers were fighting. They could never get back below the fib, and eventually the large chart momentum and path wins, but there was a huge struggle here. That was a hard trade. That was a difficult trade. That's the same one. The trade's so nice you post it twice. Odds favorable, clear path, pulls back to support. You take it. So one thing here is, and I think you asked me about this, right? You didn't have your tick data, so you didn't see that fib. I like the entry. There's your reversal bar to reduce risk. So here's your risk reduction right below here. And then it does eventually fail. And that was a 50-50. And the divergence prints and it does fail. But I agree 100%. Your read is beautiful. Your entry is great. And it's a cost of doing business there. And now that you have the fibs that you need, it makes it easier. Weak top, odds favorable, 50-50 now that you have tick replay? Yeah, for sure. It's still the right entry and good stop placement. You entered, I love that you made the font bigger too. Thank you for that. You enter with a confirmation bar because it's all the way up here. Is that right? You're like, man, it's not perfect. Let me get in with confirmation. Is that what happened here? Yeah. So instead of your stop being all the way up here, your new stop is 2 ticks above that reversal bar. And with that look on the large chart, it works out pretty easy. This is a great example of when to wait for confirmation. Because those large triggers are so far away, the risk is huge. But that confirmation gives you a place to put your stop. It redefines where the market should not go. And even if you got in on the first one better, Dad, it doesn't take it out, does it? Pretty cool, right? Great trade again. Nicely done. This isn't the best entry look. I love waiting for confirmation on that. Why not? Your money's worth it. All right. Odds favorable, clear path, pull back to support inside of favorable large triggers, and that's about the easiest one you're ever going to get. That's about the best look you're ever going to get. Odds favorable, clear path, perfect entry, out at Fibonacci resistance. That is the highest probability trend trade. I need that in my spreadsheet. People should study that one. That's everything you hope for, right? That's an easy win. So Better Dad, let me ask you, when it looks like this, can you feel that it's less stressful? Do you feel more confident in taking it with the perfect look? I do. When I take the perfect trade, I'm like, and that's where that language comes in. These jerks are going to have to come get me. You say stop loss 10 ticks because it's gold. What does that mean? Does that mean that you put your stop? It's hard to read those numbers. If you were in at 22, are you telling me that you put your stop at 21? Inside of the triggers where the market could retrace? Your arrow's down here, but 10 ticks is up here. No, okay, so that was a misunderstanding. That's for the chili dog trade, Better Dad, not for a high probability trend trade. For a high probability trend trade, I don't care what market you're trading. 4 to 5 ticks beyond those trigger lines. Cool, thank you for saying that. That's the correct stop placement. That happens sometimes. So there's a lady that used to trade with us, and it's so funny. She was working on 2 different trades, and she kept confusing the rules for the 2 different trades. And I had to point out to her, I'm like, look, put your checklists in front of you. Be able to define the trade you're in so you know where the stops go. So that would have stunk to get stopped out of that perfect look and then have it go. That would have bummed me out. Great trade, though, once again. And then weak bottom, odds favorable. Big old split triggers, so you catch it on the way up. You have a place to put your stop. Some profit, break even. Need to work on ATM for the oddities. But I followed rules, I think. Well, you made up your own management plan, Better Dad. What did it do after? Do you remember? Did it continue up from there? It tanked. Bad bottom, mid band is most likely to create a bounce. All right, confirmation. But that's not a management plan. That's an opinion. If you feel like you have to take profits 2 ticks from your entry, guys, you know you're not in the right trade. So let's just talk about the weak bottom. Mid band is most likely to create a bounce. And I don't know anything about copper and how it reacts. But when the market doesn't reverse from a key area, the mid band is a big bouncy spot. Here it bounced and took it all the way back to the large triggers. You had the wrong ATM set. Right on. Great stuff, man. Great chart reads, Better Dad. I like it. And I think that's all of them. Man, guys, always, always, always post them all. So Boaz, what you did is there's no space between the links at all. And because there's no space, it comes through as one giant link. So ways to avoid that is you can post a link and then just hit enter. And then post a link and hit enter and do it like that. Drop a space in between them. So that they don't all run together. Does that make sense? I was able to get your first one by deleting everything behind it, but that's a lot of work. Was it all the same link? The same trade? No, they're different trades. They're all different trades, I think. Here's your chili dog, guys. Odds favorable, back of the bar clears, get in, get out. Absolutely beautiful, Morgan. Nicely done. Ron says, check it out. Odds favorable, clear path. Let the bouncy stuff break. Easy money, 6-second base hit. Great job. Same things over and over and over. Cav. Everything says up and you go short. Nice job. I don't know why. I think it's testicular inflation syndrome because you're on simulator. Everything says up. You didn't even get divergence. And you go short. And I can't for the life of me. Counter trade, large triggers on the large chart didn't get through. So more time, always reversals. Been watching this for some time. So you're working on a pattern. I like it. Working on a pattern. When your account is so low you can't take a loser, you shouldn't be trading. When your account is so low, why are you trading into termination conditions? When your account is so low, why are you trading into fibs with every trigger up? When your account is so low, why are you just arbitrarily jumping in with all your indicators going up? Avoidable losses. And then Ed, you still refuse to tell me why you do anything. Odds favorable, clear path, pulled back to support inside of triggers. And you missed the easy ones because you're stewing about the bad ones. And guys, that is such a real thing. I'm going to take the wrong trade. I'm going to lose. I'm going to get pissed off. And then I'm not going to take the right trade. Trina, have a great afternoon. Wayne, have a great afternoon. I appreciate you guys being in here. And Ed, I've done it. I'm certainly not throwing stones from my glass house. But when you focus on rule adherence, guys, the losers don't sting so much. What happens in the last corner no longer matters. Amen. The difference between pros and novices is the time it takes to recover. That's one of my favorite lessons from motorcycle racing. The difference between a pro and a novice isn't the skill set sometimes. It's how quickly a pro recovers because they have the repetition to get back in the fight. So, good stuff. Boaz, do you want to try and print those again? Do you want to try and throw those in again? I don't want to miss out on your stuff. We saw the first one. Whoops. Sorry, that was better, Dad, not you. So we saw the first one, but do you see how I have to delete everything before the second one? And then I have to delete everything. And it looks like it's the same picture. It is the same picture, over and over. No, you're okay. So it wasn't 15 different pictures, was it? It was just that first picture. No, don't be sorry. Maybe a button stuck. So this is the first one in that big lineup. You can't post? Take a deep breath. Control V instead of paste. Did you, are you in the pop out? If you're in the pop out, you have to hit Control V. There it is. It won't let you just paste. It's the weirdest thing ever. Good bottom, but not perfect. So I just call it a weak bottom. Odds favorable? Absolutely. Potential to break? For sure. You take the first entry on the way up, and it never takes you out. but you get out break even, and then you say, hold it, small triggers back up, let me get back into this trade, and it works out beautifully. Hey, Cav, have a great one. Great trading today. I'll be excited to see that counter trend one and your rules on it a little bit more. It'll be fun. We can start tracking some crazy stuff. Boaz, great trade. The dance just got you another divergence. And then eventually when these head back up, great heads up that the large chart leads the way, and it goes. Mike, hope is an optimistic expectation and desire for a future event or situation, while reality is what actually exists or happening. And it is perception of the world as it is, not as we might wish it to be. Amen. The hillbilly version of that, Mike, is shit in one hand, wish in the other. Tell me which fills up first. That's my father-in-law's wisdom. But you're absolutely right. You know, my brother and I talk all the time. And guys, there's a big difference between it should and it has, right? It could and it did. So there's a big difference between what you want to happen and what may actually happen. And that's one of the reasons that patterns are such an important part of what we do. Because the pattern shows you what has happened 1,000 times, and out of that 1,000 times, 800 of them won. So even though I don't know if the market's going to go up from this point, I know that because of this pattern, it's more likely to go up from this point. Does that make sense, everybody? Believing you know what's going to happen next sets you up for pain. I'm going to go to the Mark Douglas ideas. Great segue, Mike. Thank you for that. So when you stop expecting to win every trade, you start winning most of your trades. And I don't care about the result. I care about my execution of the method. Mike knew what he was doing. He's like, let me lob Mark an easy lesson for the classroom. Thanks for that. And guys, when you believe what you know is going to happen, you set yourself up for failure when you take a loss. Has anyone else ever done that? This is perfect. It should win. And then when it doesn't, you start kicking the dog and beating yourself up. Guys, when you don't care what happens, and Jim, this goes back to your thing. When you don't care what happens, when you say, these guys have to come get me, I'm not going to give up my stop because this is my pattern. Man, it's a collection of 20 or 25 trades that you track, guys. It's never one trade at a time. But we all have this feeling that, one trade, it's the end of the world, or it's the best of the best. Up and down ticks is all there is, and you're not in control of any of them. And emotional pain comes from what you believe, and that's exactly what Mike said. You create your own pain based on your experience with the up or down ticks. So, define the reasons it may work. Define where your analysis could be wrong. Be willing to accept the risk by putting your stops where the market should not go. And guys, that is Mark Douglas. And Mark Douglas is no longer with us. Rest in peace. But Mark Douglas is the freaking guru of trading psychology. And if you go to YouTube and you type in, well, he comes up first on mine because I watch his videos all the time. This gentleman is amazing. This series, How to Think Like a Professional Trader, it's 4 hours of greatness. And guys, the whole thing is he talks about achieve consistency, have an edge, like all these great lessons. I'd encourage anybody to go back. But this one highlighted is the most profound lesson that you could ever get. When you stop expecting to win every trade, you start winning more trades. When you focus on the execution of the method, it's amazing how things work out. That one was just in YouTube, Boaz. So here, I'll get you to the one that I really like. And I'm going to warn you right now, bump up the speed on it because Mark Douglas is the absolute king of awkward pauses. You ever have that grandpa that tells you a story, stops in the middle of it, and stares at you for 3 minutes? That's him. So I bump him up to 1.5 times, but I don't get any endorsements. His family doesn't get anything out of it. But guys, Mark Douglas he was brilliant. He was brilliant, and he says things. That's right, English lit major. He says things that resonate, that make sense. I'm not in control of the market. The only thing I'll ever be in control of is taking the trades that fit the patterns. And that's what I teach every day. And a lot of Nexgen's methodology and a lot of our management training and a lot of our entry, guys, it's all stemming from him. John Novak and Mark Douglas talked almost every day for a year back in the 90s when John was creating Nexgen and learning how to teach it. Because I don't know if you know this about my brother, he's brilliant. And brilliant people aren't always the best teachers. And a lot of it comes from him. So good stuff. So it's worth a watch. It's not mandatory. And if you guys are into extracurricular, I love this book. Here it is in PDF, Emotion-Free Trading. There's this super awesome phrase in there that says, are you acting in your own best interest? Jen, I know you like to listen to it. I'm the same way. I'll have days where I'll just go, I'll dedicate an hour to listening to him. Because even though I think I've heard everything he's ever said, hearing it again is great. But emotion-free trading, I dropped the PDF in the room. Are you acting in your own best interest? When you're taking a trade into a termination condition, are you acting in your own best interest? When you move your stops to protect a tick instead of allowing it to run to your profit target, are you acting in your own best interest? When you enter from the wrong side of the triggers, are you acting in your own best interest? And if you answer that question, you'll be amazed at how much it keeps you out of. And then the same thing is true. If you're skipping a trade because of your opinion that's perfect, are you acting in your own best interest? I love that phrase. I used to work with a guy, and he wrote books on weight loss self-help. And he used to always use the phrase, well, how does that serve you? When you trade into a termination condition, how does that serve you? When you don't have momentum, how does that serve you? And it really makes you think about what happens more often than not instead of the one time. And I always thought that was a pretty cool approach to it. It's been a great class today, guys. I appreciate you. Been a lot of fun today. A lot of great lessons, a lot of beautiful trades, a lot of amazing trades that just didn't quite work. And that happens sometimes. It definitely happens sometimes.